Most people assume that when a currency is crawling on the ground, the country behind it is finished as well. This is the fairy tale the West has forced down our throats. A strong state has a strong currency. A country with a weak currency is doomed to be crushed. But what if this is one big lie? What if keeping a currency weak is not incompetence, but a professional assassination plan designed to swallow everyone at the table? China did exactly this. For decades, it deliberately undervalued the yuan, not because it was collapsing, but because it was using it as a weapon to conquer the world. And this single move changed the genetic code of the global economy. To understand this, we have to look back to the late 1970s. China had just emerged from the chaos and misery left behind by Mao's Cultural Revolution. The economy was closed off from the outside world, and its industry belonged in a museum. Then Deng Xiaoping stepped onto the stage and in 1978 opened China to the wolves' banquet of global trade under the name of reform. Factories sprouted like mushrooms in coastal cities and foreign capital was invited in. Beijing's strategy was simple. Use Western arrogance to complete industrialization at the speed of light. So if you're starting from zero and selling goods to the world, how do you eliminate your competitors? By dropping prices to levels they can never match. This is where the exchange rate turned from an economic tool into a weapon of war. Most people get lost in technical jargon at this point, but the logic is actually very dirty and very simple. Let's say the yuan's real value against the dollar should be 5. Under free market rules, as exports increase, this rate would fall to 4, even 3. That would mean Chinese goods becoming more expensive abroad. But Beijing never allowed this. The central bank crashed into the market to forcibly keep the yuan weak. At times, it fixed the rate at 8 yuan to $1. This was a massive discount campaign opened for the entire world to buy Chinese labor and goods at near-free prices. How did they pull this off? By constantly buying dollar and flooding the market with yuan. As dollars flowed into the country from exports, the central bank absorbed them and locked them away in its reserves. By 2014, when these reserves reached $4 trillion, China possessed the largest vault in the world. The result: the yuan was deliberately kept weak, Chinese goods remained absurdly cheap, and while American consumers filled their homes with Chinese-made junk, they failed to notice that they were losing their own production base. Think of it like this: a giant selling a $50 pair of shoes for $10 to wipe competitors off the market. In the short term, it gives up profit, even appears to take losses. But once competitors' factories shut down, the field is his alone. China did exactly that. By presenting itself as cheap, it built a global monopoly. Throughout the 1980s, 1990s, and early 2000s, Chinese factories flooded the world. Trade surpluses exploded. The West rejoiced, saying, "Look how cheaply we live," while Walmart turned into a kind of religious temple of globalization, with 90% of its shelves filled with Chinese goods. But the real winners were not the Americans buying cheap TVs. It was China selling them. The dollars earned from exports were reinvested into U.S. Treasury bonds. In other words, China both sold goods to Americans and lent them the money to buy those goods. This is the greatest and most ironic dependency loop in history. As America became China's debtor, China was buying the West with Western money. This is where Western arrogance truly shows itself. They mistook a weak currency for weakness. In reality, the cheap yuan was not just a tool for selling goods. It bought China time to build a massive industrial infrastructure and transform millions of peasants into industrial workers. While Western companies bragged about quarterly profit reports, Beijing was building a 50-year empire. By the early 2000s, the results of this strategy could no longer be hidden. China evolved from a closed agrarian society into the factory of the world. Its ports turned into mountains of steel. From sneakers to the most complex microchips, they were producing everything. The West called this a globalization miracle. China called it, "The plan is working." Of course, every grand strategy creates enemies. The men in suits in Washington finally woke up and began accusing Beijing of being a currency manipulator. They were right. China was wrecking the market. But calling it manipulation falls short. This was a geopolitical chess move. While cheap yuan filled American homes, industrial cities like Detroit turned into ghost towns. Consumers grew addicted to low prices, but the working class lost its bread. The irony peaked here. By financing America's debt, China was essentially feeding Washington honey while tightening the noose. America accused China of cheating, yet at the same time depended on Chinese loans to cover its budget deficits. China produced the goods, built the logistics, and lent the money. It was a colossal encirclement. While a strong currency was treated as a matter of honor in the West, a weak yuan was a weapon in China. Beijing traded paper prestige for real-world ports, factories, and mines. The West mocked China's cheap labor, but those belittled hands now hold the world's biggest technology giants hostage. Of course, this path had its costs. Artificially keeping the yuan weak required constant money printing, creating inflationary pressure at home. It also made trade wars with the West inevitable. But by the time the West fully grasped the situation and tried to respond with tariffs, China had already become indispensable. Supply chains could no longer function without it. After 2005, Beijing gradually allowed the yuan to appreciate. Why? Because they no longer needed to be cheap. The factories were built, technology had been stolen or learned, and a massive workforce had been trained. The weak currency was a ladder used to climb to the top, and once they reached the summit, they could kick the ladder away. But this playbook was not shelved. It merely changed its cover. Today, the same logic is applied to electric vehicles, solar panels, and steel. With state support, they flood markets with overproduction and low prices, bankrupt competitors, and then become the sole ruler of the sector. The industry changes, but the ruthless strategy remains the same. Sell cheap first, then conquer the world. Today, the yuan is no longer the pathetic currency of the 1990s. By entering the IMF's reserve basket in 2016, China declared that it was no longer just a producer, but a financial hegemon. It now sits at the table alongside the dollar and the euro. Yet the mindset still operates with that old Cold War logic. China no longer wants to just sell goods. It wants the yuan to become a global standard. It wants to buy oil with yuan and bypass the American banking system with a digital yuan. If this happens, Washington's dollar sanctions weapon will explode in its own hands. In the end, we must understand this paradox. Western politicians who bragged about strong currencies were merely fooling their own people. China, meanwhile, built an empire by dragging its currency through the dirt. It sacrificed prestige for power, fake wealth for real sovereignty. Americans today are paying the price of cheap goods with vanished industries and massive debts. The lesson is simple but brutal. Exchange rate numbers are nothing but an illusion. A weak currency does not always mean weakness. Sometimes it is the sharpest knife used to bring the world to its knees. History has shown us this. It is not those who treat money as decoration who win, but those who wield it as a weapon.